Matrix, adică nu e rău.
Hei, salut! Oi, gringo, como va?
One of the most important crypto events in Romania so far. Although I usually like to speak freely, this time I decided to write down my ideas because I'm very nervous about this event and the quality of the people present here. First of all, I would like to briefly introduce the guests and then came back to each one of them. Here, Vlad Cealicu, CTO and co-founder of Crypto Compare. Sabin Simionescu, CTO and co-founder of Tokero. Thomas Stanciak, CTO, founder of Nethermind. And the one and only Vitalik Buterin, co-founder of Ethereum.
I wouldn't say I know him so well, but we organized events in London because I run the London Ethereum meetup. It was the biggest Ethereum meetup. I think it still is. How I got to London, my girlfriend. So I'm from Craiova, same town, and my girlfriend wanted to study criminology and forensics because she was watching CSI, and then as you do, right? But then we found out that actually in Romania, you actually have to join the police force before you can study that. So we had a few friends that had moved to London or to the UK. And then we said, well, they've got undergrad, might as well go. And I just tagged along. So that's pretty much how I got to the UK. I wouldn't probably have left Romania if it wasn't for my girlfriend. And then something about myself, I don't know, started Crypto Compare in 2013, tried to provide data, worked at financial companies before. Charlie, my co-founder, who's somewhere around here in the room, he came up with the idea and we managed to raise 50K and I quit my job, started working on it. Then another friend from Craiova, Paul, who's not here because he didn't get vaccinated and he has COVID, exactly at the wrong time. It's such a Paul thing to do. He's fine. He's not terribly ill. He's okay. But it's just he messaged me saying, "Hey, do you want to start a company together?" And I was like, "Well, I just started one. Do you want to join us?" So it was Charlie, Paul, and myself who did the first version of Crypto Compare. And then slowly, because we had to build an API, I reached out to Matthew Tan from Etherscan when Ethereum was launched, and they started using our API. MetaMask is using our API. If you pay your taxes, probably it's our API. Hopefully you pay your taxes. We worked with a Romanian police at some point to figure out who was using our API in ransomware and try to coordinate with Interpol to catch, because it only happened at a certain time on a specific day to check prices, so they would know how much to charge for ransomware. That's why they were using our API. So we managed to coordinate the operation with Interpol and catch them, which was nice. I felt good about that. And then we started an index business. If you generally see the price of cryptocurrencies anywhere, it probably comes from our company. It wasn't, as much as Charlie wants to make it seem like it was planned, it wasn't planned. It just happened. I organized the London Ethereum meetup, and that's how I met Thomas as well. I guess that's it about me. Sabin? Just...
My career, let's call it, in programming started kind of in 2002 when I was kind of in 5th grade. Started in Visual Basic, and it took a while to get to the blockchain and crypto field. It took until 2017 when I bought my first Bitcoin. Then I bought another one. Then I sold the first one. Insert regrets here. But what I did with the first one actually got me to this point because I changed part of it to Ether. And then I noticed what you can actually do with blockchain. It's not just money, it's not just a database. It's an awesome programming environment. And the first ones, the first awesomeness came out of their work. Because now you could program data, you could program money. I'm not going to keep you all waiting for the main guests. So my only say to you this evening is, if you have not tried blockchain programming, but you have programmed before, try it. It's well worth the effort. It's the best investment you're going to make with your time this year. What's left of it anyway. Thank you all.
Yeah, great to be here. So thank you so much for the invitation. It's really an honor. And oh yeah, okay. They asked me to come a bit closer.
Oh yeah, much better.
Okay, but I'll have to keep turning back to see what I'm talking about. Yeah. So first to remember, so I work at Nethermind, so it's mostly protocol engineering company. We deal with Ethereum 1, with a bit of prototyping, applied research, with side chains, with layer 2, and so on and so on. I also work at Flashbots and work on the DeFi project called Euler. And maybe what is this about? My talk, it's about how Ethereum 1 and Ethereum 2 come together. And before I talk about it, I'll maybe bring a bit of history. How did we get to the place where we are now? Starting with Ethereum 1 that I need to scroll to.
Bit of history.
Oh, here it is. Okay, so as many of you know, and probably many of you have been here much before me, because I really started professionally to deal with Ethereum in 2017. Ethereum launched in 2015, and by today it amassed a market cap around 400 billion, and with all the DeFi and with all the things around it, it's probably going towards or much beyond $1 trillion market. So this is 6 years, and I think 2014 is when already the team behind Ethereum started working on the research on Ethereum 2. So how to transition to proof of stake in the future, how to move away from the proof of work. And maybe before I move there, let's say something that most of you already know about. So how proof of work works. We have miners who build the blocks, then post their blocks after finding the proof of work solution, and those blocks that are found the fastest have the biggest chance of being propagated the fastest, and by being propagated the fastest, they have the biggest probability of being the ones that will be included in the canonical chain, so the ones that will be forever cemented into the history of Ethereum. Those blocks are, like the whole consensus is designed in a way that those blocks are more or less 30 seconds away from each other, so distributed around those 30 seconds. And if you ever do not follow the rules of consensus, then your block is being rejected by the network. So no other miners will pick it up to build on top of it, no other verifying nodes will accept your block. So you have to play by the rules, and you just keep pushing more and more hash power to build the best blocks. Now, what was, for me, critical to this Ethereum 2 road, and obviously Vitalik would know it from the first hand, but me as a person attending DEF CON in Prague in 2018, I believe, talking to many people, it felt at that time in the middle of crypto winter, it was a bit like a DEF CON where many people were talking about the fear of an ad, of something not going well, and then at the keynote, the last day, as a closing talk, Vitalik talked about the road to serenity. And suddenly it felt like, oh, this event was all about the beginning of Ethereum 2 work, beginning of the very well organized delivery of proof of stake. And what happened at the DEF CON Prague is the group of implementers started who decided to deliver the actual implementations of the client. So building what proof of stake, beacon chain, and validators network is today. And that was quickly followed by a decision of how to fund the teams. And some of you may have seen this live on Twitter when the team said, that following a long discussion about how to make sure that the client teams can focus on delivery, and then Vitalik funding those teams and saying, you see, start, go, you're ready to go. And all of those events, I think, psychologically told the community that it's happening, that people are building it and they are focused on it full time, and they have funding and they have the specification and they have the vision of how to get there. And it was extremely strong signal for everyone to believe that we're going in the right direction and we're no longer at this research phase, which was casting doubts to the community. And at that time, Prism and Lighthouse were started as clients, and nowadays these are 2 of the 5 active Ethereum 2 clients that also participated in the last week, the merge interrupt that I'll talk about a bit. What was started around that time or even earlier was the if research page. So if you don't know it, I think that this is one of the best places in the entire internet where you can talk about the cutting edge research on blockchain, on proof of stake, on MEV, on various other topics. There are some top researchers discussing the latest, greatest ideas. There are the new joiners who throw the ideas to be criticized and come back and improve, to learn. So definitely one of the building blocks of that vision, of that strategy of delivery of Ethereum 2 was the solid research place where everybody could discuss how it should go. What was also important was the approach to Ethereum 2, which was, let's build the spec first, because if we want to have a multi-client network that will lead to better security, then we should think about it from the beginning, right? How do you get all the clients to play by the same rules and have the same access to the latest decisions, to the latest specification? By building spec first in something that's very easily accessible, that's with all the tests available, and if you go to the GitHub page with Ethereum 2 specs, then probably by putting a lot of effort, you would be able to deliver Ethereum 2 client implementation as well. So you can build the beacon chain, and I imagine it would be an amazing exercise to learn about how everything works. So then what next happens? 2020, so a few years later, after a lot of effort from Ethereum 2 clients, a lot of effort from the researchers, the exchange of ideas, some changes of the consensus design, we have the beacon chain launched in 2020 December, and since then we've seen 8 million Ether staked and providing security to the Ethereum 2 network. And those 2 networks nowadays, Ethereum 1, Ethereum 2, are totally separate. Oh, maybe not totally separate, because Ethereum 1 has the single point of entry, which is a deposit contract, where you can place 32 ETH. You can provide the different information about how you can withdraw that ETH in the future, and this is being delivered to Ethereum 2 network, picked up by the Ethereum 2 clients listening to events from Ethereum 1, and provides you with the ability to validate on the network, adds you to the list of validators. So it's around 250,000 validators nowadays, securing the Ethereum 2 network. So if you remember the time block, the block time of 13 seconds from proof of work, on proof of stake the slot is 12 seconds, so we no longer talk about block by block construction of the chain, by slot time moment when you can or may, you either produce a block or you skip that slot if you miss it as a validator. You may miss the assignment of the block production. And because there are 250,000 validators, you are assigned, on average, once every 250,000 slots as a validator to propose a block. So this is around once per 30 days, 34 days at the moment. And this number keeps growing. We don't know how far it will grow, but it may go much beyond 500,000 validators, and there are some ideas on how make sure that this number is too big by switching off some validators, switching on, and so on. And what happens if you don't play by the rules in this protocol? So if you include something that is not accurate, that probably you won't be voted on and so on, so you simply miss the slot. But the worst thing that you can do as a validator is sign things that are contradictory. So you create the attestations of proposed blocks that are like two signatures to different blocks, two signatures to attestations that attest to different things. So as a validator, you should never act maliciously trying to confuse the network and try to attack it by creating multiple signatures, multiple blocks. Whenever that happens, you're being slashed, punished, and evicted from the network after a while. So the loss for a single validator can be over 16 ETH, so it's severe punishment, and then you have to again go through the depositing process to come back as a validator on the network. So if you ever launch the proof of stake validator company, then this example situation where you can do something bad inadvertently is if you run the life setup of validators and they come back online by mistake, both of them at the same time, and they start signing. And you end up signing the same blocks but contradictory ones created on the two different setups. So why we don't want it? Because we actually want to ensure that each validator is simply a single node. So there is no sharing of validator keys. So since then, we started talking about the merge event. So the merge is bringing Ethereum 1 and Ethereum 2 together by replacing the consensus of Ethereum 1, which is proof of work nowadays, with proof of stake, but leaving the execution layer. So leaving the execution layer means that EVM, the state, all the historical smart contracts that are already deployed on the network, all that value of Ethereum 1 network stays. So Ether as the main cryptocurrency, paying for gas, paying for execution, stays and remains within this new network. And it's just the way how we decide what is the fork choice rule, how we decide what is the head of the chain, how we decide what is the latest block, what is truth. This changes and moves to the proof of stake, which doesn't require all that wasteful hashing, all that wasteful energy consumption. So last week, the 10 different Ethereum client teams met together on a 1 week long hackathon to start integrating whatever they build. And it's important to see those networks as totally separate so far, because those teams were working independently, and there is a very, very thin interface that is connecting Ethereum 1 and Ethereum 2 clients. We'll talk about this interface in a moment. And beyond that, there is lots of edge cases of how the things happen chronologically, how to listen, validate the data, and how to initiate the network together. So all this event was about slowly connecting more and more clients together in different configurations. When you think about it, 5 Ethereum 1 clients, 5 Ethereum 2 clients with 25 different combinations working together and slowly arriving in the networks when you have all the 10 clients participating in a single testnet. So this is the history. As we were progressing, we were filling the table of all the clients, telling which other clients they work with. And finally, there was this M5 phase, which was launching of the Amphora testnet. That I believe soon, with more announcements and documentation, you'll be able to connect to, and you'll be able to start launching your own beacon nodes, execution clients, and test how this execution with Ethereum 2 works. And from the perspective of the user of the Ethereum 1 execution engine, it should feel the same. So there will be blocks created with the same EVM, same state. We simply continue. This testnet will be quite empty, so it will be mostly for verifying the transition process, verifying the synchronization between the clients. For the users, most likely you will not have many smart contracts deployed there. And the last day was this already very, I included in many memes, picture of everyone being happy about launching something that was connecting all the clients together. Cool, so maybe the next one. How the merge will happen. And we have this strong feeling that this process will be very short in time. So this will be a few seconds when all of us will be looking at it. Probably not very stressed anymore, I hope only excited. But if it was to happen nowadays, probably would be super stressed. That's why the next few months will be that work of providing a massive amount of tests, so fuzzy testing of the integration testing between the clients, building together with DevOps teams at Ethereum, with all the clients verifying how they process this merge switch. So first of all, we'll set the terminal total difficulty. This will be embedded in all the Ethereum 1 clients. Total difficulty is the summed up difficulty of all the Ethereum blocks since Genesis. And we'll say that at some point, not at some specific block number, but at some point when this total difficulty reaches some level, we will switch to the new consensus protocol. And what will happen then? We'll switch off all the gossiping about new blocks on Ethereum 1 clients. So nowadays there are messages on the dev P2P network layer, low-level network layer of Ethereum 1 clients when they send messages about, I learned about the new block, or here are the new block hashes. And sending those things around will be disabled. No longer you'll be listening about new blocks appearing from other peer-to-peer network participants in Ethereum 1 world. The difficulty field will have no meaning, but will be set to 0 just for compatibility of, backwards compatibility of hash calculation for the blocks. The block rewards will be removed, so nobody will be receiving 2 ETH as nowadays for creation of a block. And what Ethereum 1 clients will start to use together with Ethereum 2 will be engine API. And maybe from this time, or even now, we can stop talking about Ethereum 1, Ethereum 2, we're talking about Ethereum, and we're talking about execution layer and the consensus layer. So what the engine API will look at. As I say, the interface is very thin, and in most cases, it uses only 2 of these 4 methods. So if you're not producing blocks, if you're not connected to validator, if you're just running Beacon node with the execution engine client, then you only execute payload and update the fork choice rule. So update the head of the chain. Execute payload is something like what nowadays is a new block arrived. The consensus client says, I learned about one new block, and I would like you to verify if that block is correct, and tell me if it follows all the rules of the state root calculation. So the state transition function is executing everything according to the EVM and state update rules. And then the fork choice updated is after the consensus layer starts voting on which block should win. If that block is selected and added to the beacon chain as a new head, this fork choice updated rule is executed, it's sent to the execution client, and execution client says, okay, this is new head, I can start building future blocks on top of it. Maybe if you go back for a moment, so now if you're actually running a validator, so if you're about to propose blocks every 1 month or so, there is also get payload, prepare payload pair. What happens if first you being asked to prepare the payload, after some time, the consensus layer asks for that payload to be sent back. This preparation of the new block, payload here means block really. So the payload is really payload from the perspective of the consensus engine, it can be anything, but from the perspective of execution engine, payload is a block. You're constructing the block. And it takes some time to construct the block, actually a few seconds, when we try to build the best block possible, but when the get payload is executed, immediately the execution engine should send the best payload in those. Okay, now actually we can look at this visualization here. So, as I said, the consensus talks to execution. The first case is when you simply execute the blocks that arrive from the network. Consensus says, oh, there is a new block that I've learned about. I'm sending it to the execution engine. I'm asking to learn, is it correct or not? That validation starts, finishes on the execution side. Then after that, both sides can say, okay, I can persist the state update, I can persist the execution rule for this block, say it's true or not. It becomes a new head because of voting, because of attestations, collection of votes, aggregation of those votes. And the fork choice update is called, and both clients agree this is the head. And the second one is when we actually have the block production. So the validator learns, oh, the next slot I will be generating the block. So I'll be building the block and I'll be about to propose the block in a very specific time frame. So it's 12 seconds. And the consensus engine says, please prepare the new payload. And this starts to asynchronously being executed on the execution engine. And after some time, after a few seconds, the consensus engine says, give me the best payload that you've built so far. And here, this is particularly critical. You'll see that the talk from Vitalik that will follow will actually talk about this area and talk about the MEV ideas behind it. So after the get payload is called, we get this new block and we send it to the network. We propose it and the other validators will start voting on our block, verifying it and voting. All right, so now what will happen during this time in the merge? What will happen afterwards? How the Ethereum, existing Ethereum 1 client, so execution engine, will synchronize the network. Because nowadays, when we synchronize the network, we use one of the multiple synchronization modes. It can be either full synchronization from Genesis to the latest block, which creates this potentially huge state, depending on the database layout. It can be a few hundred gigabytes and some models from Aragon family of the clients. It can be many terabytes in this like full tree construction storage mode. There can be also a fast sync or snap sync, different kinds of this fast synchronization that takes only the latest state of the network. And that very often combines multiple ways of going forward, going backwards, validating headers first, and then adding some information about block data, then connecting to the state, downloading the state, and executing forward. So we no longer have to verify the proof of work, mixed hash, and nonce calculation. We don't have to calculate if the result of the search of the miner of the solution is correct. Not even for the past blocks. Why not? Because the moment when we connect to the beacon chain, we learn about what the head of the chain is. And block hash of any head of any block on Ethereum contains all the information from all the way from Genesis. So the block hash changes because of any change in the header, so it changes because of state root. The state root itself changes with a single bit change in the state of the entire Ethereum data space, so all the accounts. So if we learn about one header from nowadays that it's correct for sure, that the network agreed that it's final, that it's not changing, then from that header we can go backwards all the way to Genesis block. And if we go back to the Genesis that is matching our Genesis hash, then everything is correct. Even if, not even if, but we simply don't have to validate any proof of work on the way. We don't have to validate any hash because we have a sequence of hash to parent hash, parent hash, parent hash, going backwards to Genesis. And if we can do that with execution engine, we can go back to Genesis and then we can start filling the block data, bodies and receipts if we need, so all the logs of Ethereum. And after that, from that head that we downloaded, we can start switching to the learning about this execute payload. And execute payload sends us new head all the time. The fork choice updated tells us this is the new head. And we simply go forward. So all the state download, the latest state download is still some kind of form of fast sync, snap sync. This doesn't change. But we have this additional capability of downloading backwards headers very fast. And from the user's perspective of the network, what changes? So you'll have to run a pair of the nodes, so it will have to be the execution engine and the beacon chain. When you think about the lots of latest discussions around the Ethereum 1 clients, we talk about modularity, about splitting the client between the modules like transaction pool, EVM, the state synchronization, maybe the network agents, RPC daemons. So we can think that there is a very natural split nowadays between the beacon chain implementation, the beacon node, and the execution engine. And those are like two modules of the same thing after the merge. So this will be Ethereum. It will be running as two processes that will be talking to each other over this thin interface. You'll be able to stake, and after some time, you'll be able to withdraw the Ether that you used to run validator to deposit the stake. You'll still, for a while, be able to fall back to like centralized solutions like Infura or Alchemy for running your execution engine. But over time, this will be discouraged, and some of the some of the tools, cryptographic tools, will be introduced to ensure that you're running the execution engine. And probably more predictably, we'll be seeing blocks every 12 seconds and not distributed around it, unless some of the slots are missed. Like nowadays, I think below 1% of the slots are coming without the blocks proposed. So this would be the situations where you have block every 24 seconds. And yeah, like it would be great if you read all those things, how they're coming, what's the roadmap, what changes. It looked difficult, it was difficult, but it's getting simpler and simpler as people are all arriving at the same solutions, the same specification. And thank you so much for listening. Depending on what you want to discuss, I'm providing lots of emails, and I'll be happy to answer any questions, but I'm not sure if it's coming as a QA now or later.
Yeah, we'll do QA. Thank you, Thomas.
Well, the question would be on kind of the last slide that you had. You may fall back to services like Infora. Why would that be a problem in the future?
Oh, so like
because a lot of users it's a lot easier when you're starting a very small project, a pet project of your own, to use an existing infrastructure. If you have to start the node yourself and do everything yourself, the leap that you have to do is a lot bigger for a junior developer. So that's going to mean less developers in the beginning of their career choosing this.
So there's no requirement for you to run execution engine directly unless you're a validator in the future. It's only for the validators. We want to make sure that the group of nodes that are securing the network, that they're actually verifying the blocks themselves instead of delegating it to a service like Infura.
So when we just validators that have to go through this, not all developers.
Yes, just the validators, not all the developers. As a developer building something, experimenting with the network, you'll still be able entirely to rely on some centralized solution or set up some ghost chains, like private chains, local chains, whatever is needed. And just when you're a validator, we want to make sure that we don't have 250,000 validators that all just redirect Infura saying, is this block valid? And then it's really one validator, not many.
Thank you.
And I've got a question as well. Might as well. How do you incentivize the execution layer? Why do people run the execution layer?
So, as mentioned, we want to incentivize execution layer for any validator. So, if you'll be running validator, you'll be checked if you're running the execution layer. And I think you'll learn a lot from Vitalik about the concept of MEV, where you understand that running execution layer and being able to construct blocks is a great privilege that can increase the incentive, increase the rewards from being a validator multiple times. So nowadays, the reward for being a validator is a small single-digit percentage over a year. I think nowadays it would be 3% with the current number of validators, plus some rewards for attestations, I believe. So it could be maybe like 5 to 10% per year. But with MEV coming into play, it's very different. So that split between being builder and proposer of the block, running the execution engine, running the beacon chain, as a super interesting topic, a subject of research, exactly, and Vitalik will be able to tell you a lot about it.
I have a question. Hello, I have a question regarding the staking of 32 years.
Mm-hmm.
I was wondering, after moving to Ethereum 2, is it possible to stake smaller amounts than 32?
So staking 32 ETH is required if you want to launch validator, and so far this number doesn't change. Whether it will change in the future, it all depends on decisions around consensus or what is healthiest for the network. There are different like positive and negative concerns around changing this number. However, there are already lots of services that allow people to either being developed or already tested that allow people to pull together ETH that they have to run validator in the, like for example, shared key solution. There are services like Lido, Rocket Pool, and probably many others that are being built and deployed. that allow to create liquid staking when you contribute whatever amount you want and you benefit from whatever your contribution was. Or simply pull together with some centralized operator and you split that payment, like 16 ETH from you, 16 ETH from others. So entire market, DeFi market is being built around validation. It's extremely exciting because suddenly we have this interest rates market, the yield market on Ethereum. It's almost like a fixed rate asset. Ethereum becomes the yield earning asset. And the entire DeFi space is being born around it.
Thank you very much.
Well, I've got another question in that case. Do you know of any cool solutions for pulling Ethereum together 32 for a validator, where you actually have control of your Ether, so without giving it to someone else or losing control of the Ether that is staked, like your small chunk? If you know of any cool technical solutions.
So I think the shared secret validators would be the closest to what you described. I understand that you want to pull it with a few friends and you don't want to give up your keys to others, so this will be the solution.
Nice.
And usually there is, in Ethereum too, there is a separation of the validator key and the withdrawal key. So very often what you do is someone else runs the validator keys, but withdrawal keys stay with you, so you are the only person who can withdraw the money.
I've got a simple question that I think is a good subject to touch upon. In terms of usage for transaction fees, what sort of difference should we see in the scaling of transaction fees as opposed to usage versus now?
So until sharding is introduced, we should see absolutely no difference because it's just a consensus layer replacement, and because of the block time is more or less the same and the gas limit of the block doesn't change, we should see no difference in the gas fee. So this remain the result of the supply and demand function of how much of the block space people need. And it can only change, the scaling can only change if we provide more of block space on the blocks, so there's more gas to be used, or if there's less users, less demand for that block space. The consensus layer replacement doesn't change anything, but this is the first step to introduce sharding and other solutions. It's the layer 2 that is most relevant here for the change of the transaction fees. We see more and more adoption, we see more usage of the network, so that's why even as we keep providing more block space, the fees seem to be go higher or remain on the same level. It's just because there is more and more usage. It's a measure of success, really.
Excuse me, I have a question. So right now the staking contracts are based on are on proof of work network, right, on Ethereum 1. In the future, I think that they will be on Ethereum 2, right, on the proof of stake network. So my question is, because staking contracts don't lock anywhere near close to 50% plus 1 of all ethers in circulation, is there any risk when you're exclusively on proof of stake that some other contract might pop up and say, we have a bigger stake, we are the validators that hold the keys to the consensus, and you should follow our chain? And is this in any way exploitable, such as maybe a flash crash, shorting ETH and maybe making a lot more money on that kind of behavior rather than the money that you lose because you lose your stake?
Let me rephrase this question. It's a very interesting one, actually. I really like it. So we're asking here, so maybe first to clarify, in the future that we know Ethereum 2 will be Ethereum. So this will merge together, consensus will be replaced, and it will be Ethereum. But we're talking about the deposit contract, which allowed people to deposit this 250,000 validators, so around 8 million ETH nowadays. So altogether, I think there's around 120 million of ETH that was created either initially or later as rewards, block rewards. So we're kind of asking if it would be possible to create another deposit contract and convince people to stake more than $32 billion on that contract and suggest them to switch to that as a more secure network. Is it the question, or?
No, that's not the question. I don't know where it might be. So the question is more likely some coordinated attackers can exploit this to their benefit. So it's not about convincing other people to stake to your, contract. Rather, have a contract and use that to exploit the consensus.
To attack the contract, you say, or
no? Just create another stake, that is bigger in size than the stake that other validators report to, right? And just say we are the consensus, we have the right, chain. And try to trick other people in the network that are not validators, that and tell them that you have the consensus and have a different consensus. You maybe do a double payment.
Mm-hmm. Yeah. Okay. So I understand that maybe the question is about the basic component of what the new consensus is, and all the notion of what the attack on the new Ethereum consensus, the proof of stake consensus, would be, which is exactly collecting enough of the validators under your control, over 33%, and then starting to attack the network. And while in proof of work we're talking about 51% attack, here we want to, in the proof of stake, we want 66% of the validators to agree. So similarly, you can have multiple types of attacks on this network, and similarly to proof of work, you have some kind of social consensus resolution if that happens. Which means that if the attack on the network happens, it might be that the consensus outside of the chain will be that we don't accept that chain, and then an attacker would lose extremely high amount of money. So it's similarly, we know how much of the value is at stake to secure the network. We know it's $32 billion, and to attack the network, you would have to collect over 66% of it, so you would need to have control over few billion dollars, and then if you're being rejected by the social consensus, that you're losing, having all of this slashed, right? Half of it slashed. Which makes it
might be worthwhile if you lose some billions, but you make more by, I don't know, some other type of financial,
by making people switch to a different blockchain, for example, by
yes,
throwing away the trust.
Before the social consensus can be achieved, that you have a brief time frame where, anything can happen, the price can plummet and people can benefit from that. This is.
Yeah, I think anybody who will put more than few $billion into the network should take it into account. I mean, so there's always a level of security that can be quantified, and it's best, that's a desired property of the network, to know exactly to what level you are secure. If as a big player you put $100 billion into the network, you may start to think, oh, okay, this starts to be something that may be under attack. Similarly, it can happen on any blockchain. Right? Bitcoin has some quantifiable level at which you can be attacked if you're moving money around, same Ethereum in the proof of work, and same under proof of stake.
Thank you for being here today with us. I have two questions. The first one is, do you have any idea or updates about the cross-communication between the shards? So we have multiple shards. Cross-communication between the smart contracts will be an important step. And the second question is, if the size of your stake as a validator would be an important metric to be chosen more often to process group.
I didn't hear the second part of the question about the size of the stake.
The size of the stake would be an important metric to be chosen more often to the consensus group.
So we think that maybe I start with the second part of the question, if the size of the stake affects your probability. Yes and no. So as a single validator, no, but obviously you can deploy multiple deposits. So the multiplication of 32 ETH, which means that you have many validators that you control, and the more validators you have, the more likely you as the validator operator will be chosen to propose the block. As a validator, the idea of the validator is a single deposit. But the idea of the owner of validators is the holder of multiple deposits, multiple validators, and then yes, bigger stake, the bigger chance you have to propose a block. So if you have 100,000 validators, maybe not, this is undesired, but if you have 10,000 validators, then you have 10,000 more chance of being selected. As for the first question, I forgot, please remind me quickly.
Cross-shard communication.
Cross-shard communication, okay, I know why I forgot about it, because probably I'm not the best person to answer this one. So sharding is something that's being designed, discussed, that's a very important topic. It will be coming, I think, 6 or 12 or maybe 18 months after we have the merge. It will be very important for scaling, but it's still being discussed, and I'm not a person who is best to give you the details of how exactly communication between the shards will work.
Hello. I have another question on the subject of validators. So I know the whole idea of scaling is with L2, and I'm curious if you can speak about incentivizing a transaction running on the layer 2, how that will look like.
So layer 2 is really very often in the hands of layer 2 operators. So we have projects like Arbitrage, Optimus, we have Starknet, fantastic development in the recent months. We will have other networks, Sync. We have side chains that start to behave a bit like layer 2. It's sometimes a blurry borderline. And how they incentivize the usage, either they have something as the operators that convinces users to come and join. Very often there are similar concepts to those that were invented by DeFi during the DeFi summer, so some kind of liquidity mining, farming, attracting liquidity and giving some tokens as a reward. But the best incentivization is really bringing the usage, the usability to the layer 2. So as the contracts are coming, as different DeFi protocols and useful smart contracts and NFT platforms are coming to layer 2, people want to use it because very often it's cheaper. And layer 1, layer 2, they should provide different security measures, different finality properties, and maybe not as a user, you don't want to choose it because very often as a user you will be lacking technical ability to judge it, but as an operator of decentralized app, you should be capable to choose on which layer you want to exist to deliver the best user experience to the users. Is it more important in your case to provide security? Are you exchange moving many billions of dollars at one transaction? You go to layer 1. Or you are a decentralized app for playing games or moving some small value NFTs around, right? So then you move to layer 2 and you have cheaper and faster execution very often. And for some of the users, you can stay on layer 2 without even moving between the layers. But you're secured by layer 1. So as a dApp developer, you have to choose one.
Hello, my name is Sebastian from CryptoData. Moving from proof of work to proof of stake, does transaction per second increase? Because you are competing with a project like Solana. And also, does the gas fee lowers on the new Ethereum?
Yeah, so no and no. So it may, but it's not the direct result of the transition to the new consensus layer. The transactions per second before sharding doesn't change. The gas fees before sharding do not change. What changes those is sharding and layer 2. So that's where scalability is. And we think that this transition actually brings us closer to this very efficient scalability. But apart from that, it remains the function of the supply and demand.
Okay, so there's one last question, because we're running out of time. Go for it. Yeah.
So I wanted to add, you said earlier about layer 2s. After sharding becomes active, will there be a need for layer 2s and the sidechains, or is there going to be enough scaling to operate it?
Yes, definitely there will be need for layer 2, and I think what will be the most beautiful thing will be the cooperation of sharding and layer 2. There were some very interesting research papers recently published or exploration of the design that includes the rollups within the concept of sharding and using shards as rollups and so on, so I really encourage you to read that. We expect that those solutions will work together to provide scalability that will simply multiply the effects of those two approaches.
Okay, thank you, Thomas.
Thank you so much.
Yeah, I guess you've all been waiting for Vitalik, and we've made introductions, so please go ahead.
Thank you. Yay. So actually, before I start, there's a few of the questions from last time I wanted to also give some of my own answers to. A bunch of people asked about sharding. One of the kind of important nuances of sharding is that the sharding that we're working on right now is just sharding of data, right? So what that means is that at the protocol level, what's being built is just shards where those shards hold data, and that data does not mean anything, right? So the shards does not contain transactions that the Ethereum protocol is going to verify. You know, the reason why we want to have shards that hold data is because the blockchain still maintains consensus over whether or not that data is actually available, so whether or not that data was actually published and anyone can download it. And it turns out that this is a very important feature for rollups, right? So the sharding roadmap is designed to not around like transactions happening on shards directly, it's designed around transactions happening on rollups, and then those rollups being able to put their data onto shards. And that gives the rollups much more scalability, right? Now, if you want to understand like the reason why rollups need data space, I wrote a couple of articles on this on vitalik.ca, my blog. If you just search for the word rollup or search for the word base layer, you can find it. But basically, like scalable execution is kind of done on layer 2s, and the vision here is that what's the Ethereum chain today kind of primarily becomes more of a place for high-value transactions and a hub where all of the layer 2s kind of commit their data to verify their proofs, do their fraud proofs, verify their snarks, kind of like just all of the stuff that the layer 2 protocols need to do on chain, right? So I think like in the midterm future, the average user of Ethereum will be a user of a layer 2 that commits to Ethereum, which is important, right? That's a fairly big change that the ecosystem is going to have to adapt to. A lot of tools are going to have to adapt to it, like ENS, for example, is going to have to adapt to it. Wallets will have to adapt to it. So it is an important change that will happen in the ecosystem over the next 1 to 2 years. But kind of the practical result of this, right, is that the consensus layer can be kept simpler. And there's a lot of technical reasons why sharding of just data is actually safer than sharding of data and execution for now. In the long term, when we have snarks of the EVM, we could always reconsider that decision. But for now, just data, simpler to verify, simpler to prove, and all of these more complicated things around like rollups, actually doing execution, even cross rollup transactions, that can all be done through kind of higher level protocols, right? So cross rollup transactions, it is a fairly application specific thing. Like I've written up a couple of proposals for how it can be done. Other people have written up proposals, but definitely very important research area. So that's one question. Another one was there were some kind of queer questions about like what to do if you don't have 32 ETH, which is also important, right? So one question is like why can't we just reduce the floor, right? Why can't you just say instead of needing 32 ETH to have a validator, you need say 4 ETH to have a validator? The reason for this is because if you need less ETH to have a validator, then the beacon chain will have to support many more validators. And that will make the beacon chain much harder to process, and so that will make Ethereum more centralized in a different way. Now, you could argue that we chose the number 32 when ETH was at $100, now ETH is at $3,500, and so now like the challenge of affording 32 ETH is a much bigger problem than the challenge of affording a bigger computer, so we should decrease that number. That's a decision that we always could consider. Another thing that we're considering is I also have the separate ideas around, if you just search for the word, the phrase single slot confirmation, or single slot finality. Basically wrote up a couple of posts about how to kind of redesign the beacon chain so that it finalizes faster. It's based around like large committees instead of using the entire validator set. And if we do that, that also kind of would make it easier for us to reduce the the size of a deposit in the when you have more validators. And then the other approach, of course, is stake pools, right? So this is kind of like the usual argument for people who say, like, let's keep the valid deposit size 32 ETH the way it is today, is that they say, well, actually, individuals don't need to solo stake. We can have decentralized stake pools. Today, like, stake pools are basically all either centralized or trusted, right? Like even Lido, for example, like it's theoretically a decentralized stake pool, right? But what happens is, like, there are a lot of individual operators, and every one person who stakes gets assigned an individual operator. Now, because, like, what you can do today, right, is you can set up a system where the operator stakes for you, right? And if the operator screws up, then your balance might get an activity leaked, or you might even get slashed. But the operator has no way to steal the funds. And the reason for that is that instead of the withdrawal address being an address controlled by someone, the withdrawal address itself is a smart contract, and then that smart contract is actually has the rules that say, like, when the money comes out, 3% of it goes to this guy, 6% goes to this guy, 4% goes to this guy, and so on, right? So whoever's doing the staking on behalf of a group of people, like, they would be able to they would not be able to steal the funds, right? But it's still kind of centralized because, like, you do have to trust one particular operator to, like, do a good job of staking and to not get everyone slashed. The technology that fixes this, as Thomas mentioned, is secret shared validators, right, which basically allow you to actually kind of decentralize the validator function between, like, say, 3 computers or 5 computers or some other number of computers. So this is just like other more advanced technology to have kind of decentralization at a higher level, right? So I think, like, people who think about improving staking decentralization, they're in kind of one of two camps. So one camp basically says, try to knock it down from 32 to 4, maybe potentially even knock it down to 1 if Moore's law becomes better, or we have, like, synarchs and we can scale more. And then the other camp says, like, the number 32 is fine, but validator slots are generally not intended for people. Validator slots are intended for kind of staking pools, and we can have decentralized staking pools that are trustless that have many participants, right? So two different approaches there. So that's kind of for scaling and decentralization stuff. Now, since we're talking about centralization, we can get to the centralization topic I wanted to talk about today, which is MEV centralization. So, what is MEV, right? So MEV, it stands for minor extractable value, and basically what this means is that it's like value that the miner, or more generally what we call the block proposer, whoever has the ability to choose what goes into a block, can extract from having the right to create a block and choose what goes into it, right? So there's many different types of MEV. Probably the simplest MEV is that you can include transactions, and when you include those transactions have priority fees, and the priority fees go to you, right? They go to whoever actually is creating that block. There are more advanced forms of MEV, right? So one of the big ones that really emerged over the last year is DeFi arbitrage, right? So, like, for example, let's say right now, you have ETH and you have DAI, and let's say the price of ETH in DAI is, like, say, 3,500, right? Now, 12 seconds in the future, there's trading happening on Binance, right? Like, on Binance, there's constantly people buying, there's people selling, and let's say, since the previous block, there's some trades happening on Binance, and now instead of the ETH DAI or the ETH price in dollars being 3,500, that price is, say, 3,507. Right? Now what happens? Well, whoever controls the next block has the ability to put in as the first transaction, a transaction that goes on Uniswap and then buys up all the DAI between $3,500 and $3,507, right? So they buy up a bunch of DAI at an average price of $3,503.5, and they make that $3.50 profit on possibly a fairly big chunk of cash, and then at the same time they go on Binance, and then they sell some DAI over there. So they just do a simple arbitrage and they make some profit, right? So now this isn't just ETH to DAI on Uniswap, right? Like, there's a lot of different token pairs. There's also a lot of there's right. There's a lot of different. So one type, for example, is internal Uniswap arbitrage, right? So there's a lot of different Uniswap pairs, and sometimes Uniswap is like inconsistent internally, right? So like let's say you have 3 assets, A, B, and C. And let's say someone buys A for B, and then the price of A goes up. But then if you take the price like A over B multiplied by B over C, that doesn't agree with the price of A over C anymore, right? So then what happens is someone can do a triangle trade. They can trade A for B, then trade some B for C, trade C for A, and they can do this in a single transaction, and they can make some profit. Another type of arbitrage is different exchanges. So let's say Uniswap versus SushiSwap. So you trade A for B on Uniswap, and B for A on SushiSwap. You can actually do this even if you don't have capital, right? Because you flash loan it, right? You make a transaction that Flash borrows either through Aave, or I think Uniswap itself offers this flash loaning service. Basically, like you borrow these tokens and then you have to pay them back within the same transaction. And if you don't pay them back within the same transaction, then the whole thing reverts, right? So you just borrow a bunch of A token, you trade it for B on Uniswap, and then you trade it back for A on SushiSwap, and if the prices are different, you make a profit. Third one that I mentioned, Uniswap versus off-chain exchanges, right? So like I would say, you do a bunch of trades and you move the Uniswap prices to equal whatever the prices moves to on Binance. So that's all arbitrage. There's also liquidations. So like for example, CDPs on MakerDAO, right? Like CDPs on MakerDAO, basically, it's this kind of smart contract where you have some ETH or some other assets as collateral, and then you have some debt denominated in DAI. Now, if the price of ETH drops very quickly, then sometimes, like if you're not careful, what might happen is that the price of ETH the ETH that's in your CDP is like almost not enough to cover the price of or not enough to cover the debt. And MakerDAO has this mechanism where before that happens, anyone if it gets close to happening, anyone can send a transaction, they can poke the CDP, and they can close it, right? They can force liquidate, what happens there is that all that ETH gets sold, and then when all the ETH gets sold, it gets, whoever does the liquidation, they basically buy off some ETH cheaply, they get a reward, and whoever CDP gets liquidated loses a lot of money. There is actually a fun example of this. Justin's son apparently came very close to losing something like $1 billion from a liquidation event almost happening a few months ago. Apparently, as I remember, there was even like a period of about 5 or 6 blocks during which anyone could have sent a transaction that would have grabbed $100 million from Justin's son's CDP, but it just turns out that no one did. I think because back then we didn't have EIP 1559 yet, so the transaction fee market really sucked, and so no one was able to kind of figure out the gas fees, and so, fortunately for him. But if that happens, then that is a $100 million MEV opportunity, right? So MEV is, there are many types of MEV that are hard to find, that require kind of sophisticated software, sophisticated machinery to find. You might need to have you need to have some money on all these different kind of on-chain exchanges. You might need to have accounts at Binance, accounts at Poloniex, accounts at I guess Tokero maybe. Right? You just have to be able to do all of this complicated financial stuff. So optimizing for getting as much of this kind of hard MEV as you can is hard. So basically, because discovering MEV is this kind of very specialized problem, it's a centralization vector, right? There's this problem with economies of scale where if you're a large mining pool, or after the merge, if you're a large staking pool, you can go hire entire teams that write software that try to optimize for MEV extraction and do a really good job of kind of grabbing and optimizing for all of these opportunities, right? Now, if you're just an individual staker, if you're just a random guy and you have your 32 ETH, or you're even a random group of 20 friends that have pooled together 32 ETH, then it's much harder for you to do this, right? And so kind of bigger players have this advantage and smaller players don't. And this is this centralization risk of MEV that a lot of people are worried about. So, Flashbots, right? So Flashbots is this interesting kind of service that announced itself, I think, about a year ago, launched fairly soon after. And Flashbots is this kind of service that basically is intended to allow, like right now, miners, but I guess after the merge is going to be stakers as well, to basically plug into this market where they can basically kind of sell off their MEV rights to someone else, right? So if you're a small miner and you have no idea how to gather MEV yourself, then you can just kind of plug into the Flashbot system, and then there are these actors called searchers, and searchers are these experts that understand all of these MEV strategies. Searchers can propose bundles, kind of collections of transactions, and they include a bid, right? So searchers can say like, hey, here's like a set of 5 transactions, and I want to be paid 0.65 ETH for, if these transactions get included, right? And presumably these transactions would have like a little bit more than 0.65 ETH of MEV in them. So you have this kind of separate class of actors called searchers that optimize for discovering and taking advantage of all these MEV opportunities. And then you have miners that connects to the Flashbots relay, and all that miners have to do is they have to look around and they have to see what bids the searchers make, and they just pick whatever the highest bids are, right? So miners don't have to understand MEV themselves, they just see a bunch of bids, and they just have to choose the bid that pays the most. So, big improvement for miners, but the current Flashbots design still has 2 very important problems, right? So, the first problem is that it actually requires miners to be trusted. And this actually means that it's not that good in its current form of actually doing what it wants to do, which is to kind of make things more fair for all the miners, right? So this is fairly subtle. The reason why this is true is because if a miner receives a bundle from a searcher, right, then often what they can do is they can inspect and they can see what strategy the searcher used, and then they don't include those transactions. They don't pay the searcher. They just steal the strategy, and then they just grab all of that MEV revenue themselves. Right? Now searchers are very scared that miners are going to do this, right? Because if you're a searcher, and you spent all this hard work figuring out these MEV strategies, you don't want miners to just kind of grab it and kind of take your, just use your strategy without paying you. Sometimes it's even worse, right? Sometimes it might even be possible to claim, these strategies basically require, collecting MEV requires you to make yourself vulnerable to MEV attacks, right? If you do some kind of arbitrage and someone else who sees that you're going to do that arbitrage, you can put some transactions in front of your arbitrage, and then they can steal a lot of money from you. So often if you send these bundles, and then someone has the ability to kind of get in the middle and say, oh, I'm going to insert my own stuff before these bundles, then they have the opportunity to really hurt you, right? So right now, Flashbots requires trusted miners, right? Basically, Flashbots knows who the miners are that are connecting through their system, and if any of these mining pools end up breaking the trust and they end up doing these MEV stealing things and they get caught, then they would get kicked out of the system. So not a very decentralized system in that way. It's okay in its current form because proof of work mining is just not very decentralized, right? Because there just are a few pools that really do control kind of how most of the mining in proof of work Ethereum. But in proof of stake, we're trying hard to make it much more decentralized, right? So in proof of stake, we want as much of the stake as possible to just be random people, right? And random people are untrusted. So it becomes more difficult to see how this kind of design works and does what it kind of strives to do in proof of stake. So that's one problem. It turns out that this problem is actually solvable with trusted hardware, right? Basically, you use some of these kind of trusted hardware chips, SGX is one. There's Amazon EC2 offers a trusted hardware service. A lot of phones have built-in trusted chips of some kind. And what searchers do is they encrypt their bundles using a public key where the corresponding private key is inside of these SGX modules, right? And then what that means is that only if the miner actually creates a block and in the proof of work case, like creates a block with the proof of work, in the proof of stake case creates a block and broadcasts and gets some more signatures on it, only in that case can you actually decrypt the contents of that bundle and turn it into a valid block, right? So basically, the miners do not actually see the contents of the bundles that they're including until it's too late for them to do any of these attacks against it. So if you trust trusted hardware, then this is solvable. Now the good news is that you don't have to coordinate around one single type of trusted hardware, right? You can have an open market, you can have like different miners use different or trust different kinds of trusted hardware. You can have different searchers trust different kinds of trusted hardware. So if you're willing to accept this trade-off, then you can solve the problem. And then, but there's also the second problem, right? Which is that the Flashbot's relay in its current form is a centralized system, right? Like it's a server, the miners talk to the server, the searchers talk to the server. So, it's one thing, it can go down, it can potentially censor, it can do a lot of mean things. So, what would be ideal is if we can decentralize the Flashbot's relay. So, there are a number of different ideas about how to do this, and the thing that I'm going to kind of talk about here is an in-protocol kind of built-in decentralized Flashbot's relay, right? So basically, an in-protocol built-in mechanism that does what we call proposer-builder separation, right? So the proposer, so the actor in proof of stake who has the kind of theoretical right to propose the block, and then the builder who actually creates the block, become two separate actors. And it basically becomes an in-protocol auction, right? So the proposer is going to accept bids, and a bid is just a message that says, here's the block header, here's who I am, here's the hash of the block I want to include, and here's the bid I'm willing to pay. And the proposer just chooses the winning bid, and then the winning bidder gets some period of time within which, in protocol, they have the ability to reveal the block and get the block included. Right, so basically block proposers sell their proposing rights to the highest bidder. Bids only contain the hash, and the builders only reveal the body after the blockchain has confirmed that they are the winner, right? So basically the step is that step one, you have the beacon block, you have these bidders, right? So these are the block builders, and they send these bids, right? We call them I call them execution headers here. And each of these bids contains a hash. It contains the kind of like the validator ID of the bid. No. It contains the validator ID of the bidder, and it contains what the bid is. Now then you have the block proposer, and the block proposer chooses one of these bids, and obviously they're going to want to choose the one that has the highest bid, right? Then there's a deadline, you have some attestations, right? It's kind of like the end of a slot. You have a bunch of validators that basically confirm that this block is part of the chain. And then once that happens, the intermediate block has can be created, right? And the intermediate block gets created by the builder, right? So basically, this block just auctions off the right to create this block. And this block has the ability to include the body, and the body has to match the header, and the body here actually is the block that they wanted to create. Now then after this, you have some more attestations, you have a bunch of validators confirming this, and then the cycle begins again, right? So basically, it's like a two-step process. First step, you agree on who has the right to create the block, and that's just like a single slot to confirm the result of an auction. And then the second slot is like actually using that right and being able to actually create the block. So fairly simple design, right? Or at least it's as simple as something like this can be, right? So what are the security properties that it has? It has a lot of nice security properties, right? So one of those properties is that payments to the proposer is unconditional, right? So what this means is that proposers do not need to trust builders. Proposers do not need to care about whether or not the builder is honest. And the reason why this is important is because like we want these schemes to be as decentralized as possible, right? Like we don't want you know, proposers to have manage whitelists. We don't want builders to have to manage whitelists because like every time there's a whitelist, it's always going to be the big pools that are going to get on the whitelist, and if only the big pools can get on the whitelist, then you've created a centralization vector again, right? Like we want proposing to be as decentralized as possible, and like we want building to be as decentralized as possible, but it's actually more okay if building is centralized, which I'll talk about later. So that's the first property, right? So proposers, they just have to choose the winner of the auction, and that's how they get the revenue, right? So very easy to be a proposer, very kind of decentralization friendly to be a proposer. Now the builder. The builder has to reveal on time, right? So when the builder, if the builder wins one of these auctions, they have this period of 8 seconds during which the builder can reveal their block, and they have to actually reveal it on time. If they do not reveal it on time, then they pay their bid to the proposer, but they do not collect their fees from the block, right? So it's entirely the builder's responsibility to reveal on time. No risk of MEV stealing, right? So basically, the builder is only going to reveal once the block that confirms that they won the auction is safe, right? So basically, and if the block is not safe, then the builder has the ability, the builders can either not bid, or they can, if they want to, they can make lower bids. They can say, oh, the chain is looking very unstable right now, and like maybe there's a 20% chance people are going to screw me over, and I think I can get a 10 ETH profit from this block, but you know, because there's a 20% chance I'll get screwed over, I might only bid 7, right? They can, like builders have the ability to do that, right? And because builders can actually see like basically how safe the chain is, like how many attestations there are, what the network situation is. So a lot of the complexity gets put on the builders, and this is part of the intent. Now, censoring the builder, it does require basically either extreme network latency or a 51% attack on the committee, right? So it's still fairly secure for builders. It's you know, very secure for proposers. Next step. So what about transaction censorship, right? This is kind of one of the bigger concerns here, right? Basically, what we're doing here is we're kind of completely changing the mechanism for how the transactions in a block get chosen, right? Instead of like it being a completely different proposer each round that's making the choice, what we're basically doing is we're saying proposers just auction off the right to create the block to the highest bidder. And being a builder is like, it is a very kind of intensive thing, right? Builders are the ones that are going to have their accounts on Binance, have their accounts on Poloniex, have, you know, their accounts on Tokero. You know, they're going to be able, like, they're going to be talking to Uniswap and SushiSwap. So, like, builders are something that could become very centralized, right? Like, there could be 3 or 4 big ones. There might even be one that wins like 80% of all the blocks. And so, if like building becomes centralized, then like can the winning builder start censoring everyone? And the good news is that there's a good argument that they can't, right? And the argument basically is that if you're a censor, then you miss out on transaction fees, right? So basically, and then someone who's non-censoring has a very big advantage over you, and they can outbid you, right? So let's say there's a block. And in that block, there is, like, let's say, 1 ETH of fees that you can claim, and you wants to censor, like, say, 10% of them, right? You don't like 10% of them. Then you can only get like 0.9 ETH worth of fees, and so your bid, like, it's going to be less than 0.9, right? You might bid like at 0.89. Other people who don't care about censoring, they're going to see the transactions, they're going to see the 1 ETH fees, and so they're going to make bids of like 0.99. And so even if they're worse at doing all of the MEV optimization stuff than you are, like they could still, like if you went to start censoring, they could end up outbidding you, right? And I think one of the reasons why here is because like if someone starts being censored, then one thing they could do is they could increase their priority fee, right? And like if you look at what's happening right now, priority fees are fairly low, right? Like priority fees and MEV, like maybe I think MEV is like on average about 0.2 ETH a block. Sometimes it's less. Priority fees are like I think at this point somewhere between 0.5 and 1 ETH a block. I think as more people adopt EAP 1559, priority fees will drop. It might be 0.2. So the amount of fees that you get is fairly low, but then if you have only a few censored users, like if you get censored and you really want to be included, you're going to be willing to just have a really high priority fee, right? Like you might have a priority fee that just equals your base fee, right? You just double the amount you pay, but then it turns out that, well, if you double the amount you pay, you're increasing your priority fee by a factor of, like, say, 20, right? And if your priority fee is 20 times bigger, then, well, we only need a few censored users for their fees to be able to kind of start overcoming, like, the difference between the priority fees and MEV that the best builder can collect and the priority fees and MEV that the open source builders can collect. Right, so basically, if the priority fees of the censored transactions start exceeding kind of the bid of whatever builder is trying to censor minus the next best bid, so minus, like, say, the bid that all of the open source bundlers are making, then if you want to keep censoring, like, you basically just have to lose money every block to outbid them, right? And you'll go bankrupt very quickly. So this is a kind of fairly nice and simple economic argument that says, well, like, actually, even if this starts looking extremely centralized and it starts looking like you have one builder that's making 90% of all the blocks, in practice, like, there still is this very strong market discipline, right? And if they start misbehaving, then other people can start outbidding them very quickly. So that's some, like, those are kind of some of the reasons why we think proposer-builder separation is interesting, right? Like, it creates all of the nice properties that the Flashbots relay exists today, and except it does this in protocol, and it seems like it has some good decentralization properties. It allows proposers to be very simple, very dumb. Proposers just have to choose the winning bid. Once we add stateless clients, right? Once we add verbal trees, which is another thing that we're working on, like, even like ETH2 or consensus nodes, like, even including proposers, might actually be able to be stateless, right? So they won't even have to store the Ethereum state, they just have to download and verify some information, right? So it could become very easy and kind of very, like, relatively low resource to become a validator and even a proposer, but basically because the complexity gets shifted onto builders. But there is this kind of, like, strong market discipline happening here where if the best builder starts misbehaving, it becomes very easy for other builders to start, like, you only need one honest bidder to start outbidding them. Now, so it turns out that there are still, like, in this kind of design, right, like, there are still things for Flashbots, the organization, to do, right? So, like, for example, you can actually make a kind of SGX-based system that provides the same kind of pre-trade transaction privacy, and you can do it as a kind of wrapper around proposer-builder separation. So there's actually ways to extend this kind of design, and you can even get the benefits of their kind of current private relay endpoints that they have today as well. Now, last kind of important question here, right, is that, like, you might ask, well, is proposer-builder separation risky to deploy quickly, right? Like, this is a new idea. We have a lot of reasons to believe why this idea might work, but, you know, it still has some risks, right? Like, it's a new mechanism, and it's a mechanism that changes not just the technology, but also the economics, right? And it changes the economics to something that does not even exist yet on other chains, right? Like, if Ethereum just switching to proof of stake, well, you know, Purecoin has had proof of stake for many years. NXT has had proof of stake for many years. A lot of these newer chains have proof of stake. Technology, you know, okay, fine, we have zero-knowledge proof. Well, Zcash has zero-knowledge proofs. And even if there's completely new technology, like, technology is very kind of constrained, right? Like, if we're confident that the technology works, then we can just introduce it. Economics is more challenging, right? Because economics, like, your economic model is not necessarily going to survive contact with reality, right? Like, people might behave differently from how you expect people will behave. Now, Ethereum does have a history of some fairly radical economic experimentation, and EIP 1559 is probably the best historical example of this, right? About 2 months ago, like, we did this complete redesign of how the Ethereum fee market works, where instead of being this kind of inefficient first price auction mechanism that most other blockchains work. Instead of that, you have this mechanism where there's this constant base fee, and users can pay a priority fee on top of it, but if they pay a fairly low one, then most of the time they're fine. And instead of spikes in demand leading to spikes in the fee, there's some slack in the block space, and so spikes in demand can just lead to kind of temporary ups and downs in the usage of the chain, like in the amount of gas that goes on chain. And this mechanism, it's famous because of the burn mechanic, right? The base fee gets burned, and because of this, almost 500,000 ETH has been burned so far, which is really fun. But it also has this really nice property, right? Where if you send a transaction today, very easily your transaction will get included within the next block, right? How many people have tried sending transactions recently? Let's see. It's easy. It's easier now than like 3 months ago, right? Like 3 months ago, you send your transaction, and you have to choose: am I going to pay this fee, and then is it going to get in 1 minute, 5 minutes, 15 minutes? Now it's much easier, right? So, I think in Ethereum we love economic experiments and or at least kind of economic innovation, and economic innovation has had great results, but EIP 1559 has had 2.5 years of economic review, right? There was a lot of these big game theory researchers that looked at it. The Ethereum research team looked at it for a long time, but there are a bunch of audits of it. Proposer-builder separation, there's a big chance it will come much faster than 2.5 years. Now you might ask, well, is it safe, right? Should PBS also wait for 2.5 years? My answer is no, and the reason basically is that the blockchain, the status quo is not guaranteed to be safe, right? Because we're not adding a new feature into an ecosystem where we know that ecosystem is safe because the ecosystem has been safe before. The ecosystem itself is very rapidly changing under our feet, right? If Flashbots never existed, then at the time Flashbots was starting, there were already mining pools that were starting to talk about doing MEV optimization themselves. If Flashbots did not exist, mining could have easily become much more centralized. And if in-protocol decentralized Flashbots doesn't exist, then Flashbots, the centralized version of Flashbots might become really entrenched, right? So basically, there's all of these kind of the ecosystem itself is basically this big experiment, right? There's this rapid growth that's happening in the ecosystem, all of these new applications that are happening, there's applications that are reacting to other applications, and so if you just did the same thing that you do before, there's no guarantee that the ecosystem will continue to work the way it did before, right? So we actually need, the choice is not kind of slow and steady change versus fast and reckless change. Basically, it's kind of fast and reckless change versus kind of reckless failure to change as other things change in a more chaotic and uncontrollable way around you, right? So, that's kind of a reason why I think it's good to be quick on these things, right? Because the Ethereum ecosystem is kind of in the middle of this this complicated transition, right? There are all of these very complicated DeFi things that are happening, and in the long term, this is good, right? In the long term, it's good that Ethereum is maturing. It's good that we're actually figuring out kind of what all of the pain points on the system's incentives are, and it's important for Ethereum to grow through this stage in order for it to really become this kind of big global system that a huge amount of really important infrastructure actually runs on, right? But right now, there are a lot of these very strong economic pressures, and the ecosystem does need to, I think, move fairly quickly to adapt, right? So I think we are going to be hearing a lot more about MEV centralization, about in-protocol ways of getting rid of MEV centralization in the future, or at least in-protocol ways of managing and kind of mitigating the bad consequences of MEV centralization in the future. So what's left with kind of in-protocol proposer-builder separation? One is just verifying that the mechanism works, looking for unexpected weaknesses, right? This always happens, right? There's new mechanisms, and then it looks correct, and then a month later someone says, why it's not correct. This has happened in consensus research 10 times. even in LMD Ghost, the fork choice rule, like we now know that there's like a few bugs in it that we did not even realize existed 2 years ago. And so now we're looking at things like proposer boosting, and proposer boosting is this fix to LMD Ghost that's looking like it'll go in at some point. So like it's always possible to fix problems, but it's much better to fix problems before the thing that has the problems actually goes live. So verify that it works. Look for unexpected weaknesses, hope that there aren't any, and if there are, fix them. Extend it to shards. So this isn't just about choosing what goes in execution blocks, it's also about choosing what goes in shard data. Shard data is going to have MEV as well, because shard data determines what goes into a rollup. So rollups have their own MEV issues, shard data has their own MEV issues, and like after that, deploy, right? So this, I think, like, the nice thing about this particular kind of change, right, is that from a technology standpoint, it's actually not very deep, right? Because from a technology standpoint, it's just a chain. You know, you have blocks, you have committees, you have more blocks, you have more committees. We don't actually need like really fundamentally new technology, right? Like with with sharding, we need fundamentally new technology. You know, you have data availability sampling, you have like a peer-to-peer network with 2048 subnets, you have all this crazy stuff. From a technology perspective, like sharding does have a lot of insane things in it, right? And so, like that's why, when there's projects that talk about how they have sharding now, like they often do have some simplifications, right? They say, oh, we only have like 4 shards or 8 shards, like it's sometimes partial sharding, right? The compromises are different. There's a lot of different projects that try to do sharding, right? And it is a hard challenge. But the good news about BBS is that, like, from a technology perspective, it actually is, I think, fairly kind of understandable. Look, we just have to use the tools that we already have. From an economics perspective, from a game theory perspective, from a perspective of not breaking the incentives, then like there's some more challenges, right? But if it works well, then we can actually like solve ahead of time what might be one of the big, probably the kind of like the instability in the Ethereum ecosystem that I'm worried the most about right now. Like I think if we just look at things that I'm worried about right now, like basically the biggest thing is centralization risks, right? And like centralization risks, well, we have staking centralization risk, and so we have decentralized stake pools. We can reduce the try to reduce the minimum. Then we have MEV centralization. MEV centralization we can try to fix by kind of doing things like this to manage it in protocol. And then we have Infura centralization, and Infura centralization we can mitigate through some of the work that we're doing already on light clients. So like I think we have a lot of opportunities to actually address all of these pain points and address the existing ones and address the new ones before they actually become a big deal. But the good news is that there's lots of very smart people working on these problems, and you can be one of them. The proposer-builder separation proposal is up on ETH Research. Anyone's free to comment on it. Same with all of the sharding ideas. Same with light client protocol ideas. So if anyone wants to participate, then they should feel free to.
Okay, thank you. I don't know about everybody else, but I will need to give that another watch because I had a few light bulb moments and I was like, yes, this makes sense, and then, okay, I follow, and then so I'm definitely gonna watch the video again. Quick questions, if there are any. Yes, over there in the back.
Hi Vitalik, it's a pleasure to have you here in Romania. Thank you, it's a pleasure to listen to you. I'm Crypto Esco. I have 2 beautiful questions for you. How do you feel about Warcraft 10 years after doing that terrible thing to your warlock? And second one, what do you feel about NFTs and world-renowned artists minting on your blockchain?
Interesting. I guess like the questions are kind of related, right? Because like Warcraft is a centralized virtual world, and NFTs are a building block of a decentralized virtual world. I guess I don't know. Like I definitely feel like kind of follow the gaming space less than I did before. I mean, it was also interesting to see that kind of like World of Warcraft as a whole definitely became like a bit less relevant than before. And I think like the reasons why it became less relevant for me, I mean, aside from like that really neat thing that they did with the warlocks, is it just at some point like you get to a certain level and like there's just not much more to do, right? And you have to like spend 6 weeks and you get one item, and then 6 more weeks and you get one item, and it just gets boring. But then when I read about why other people get tired of it, and like they got tired of it because the game, like Blizzard basically started making the game easier, and that ended up killing the social features. So, and that's interesting, right? And like, I guess there's many different kinds of players, right? And this is one of the reasons why I think like the metaverse is going to be a very heterogeneous thing, right? Like there's some people who like doing the social thing. There's some people who, like trading degen monkey tokens. There's some people who just kind of like exploring, and some people just like hanging out with their friends. And that's, I guess the thing that would be interesting is like, can we create, like, actually realize this vision of like creating some kind of more linked virtual environment that actually where you can have kind of like different islands in it that are where you have game designers, but where you don't actually have like everyone living inside of Blizzard land, or everyone living inside of Mark Zuckerberg land. But like Mark Zuckerberg can have a room, and if people want to go to the room, they can, right? But Mark Zuckerberg should not own the hallways, right? And the hallways should run on Ethereum, okay, maybe how about like the highways run on Ethereum and the hallways run on Optimism and Arbitrage, right? Like that's layer 2 is the spirit of rollups. I feel like NFTs in their current form, like the challenge with NFTs is that I think people should be very careful to not assume that NFTs in their current form are like going to be a permanent part of the world going forward, because like they've only survived for 6 months, right? And they've only survived for like 6 months during the bull cycle of a crypto bubble. We saw how big ICOs were in 2017. Well, where are the ICOs now, right? So are the NFTs that everyone's buying right now going to go to zero, or like go down by 99% in 2023? I don't know. Like this is it's a big kind of unknown, right? And they might not, right? So I think don't start building your model of the entire future around something until it survived at least one crypto winter. I mean, it's kind of one piece of advice. Now, what I think NFTs need to do in order to survive the next round of crypto winter is I think NFTs are going to need to like be more than just like basically hashes of JPEGs that you go off and buy for $3.4 million for some reason I completely don't understand, right? Like NFTs need, or like, sorry, I was going to say NFTs. NFTs need to they need to have like interesting properties that make people care about them. And like the connection to video games here is interesting, right? Because like games and like rich virtual environments in general, like that is one great way to actually give NFTs meaning, right? Like you can have games that give NFTs meaning. You can have like decentralized social applications that give NFTs meaning. One very early example of this that I really liked is that like back a few years ago there was this sort of semi-decentralized Ethereum-based Twitter alternative. It was called PPF. And they had this feature where if you donate $25 to the Against Malaria Foundation, you basically get this kind of proto-NFT. It was like this little picture of a bug. And this picture of a bug just kind of goes on your profile and everyone can see that it was on your profile. Right? So it's like, okay, you donate $25 to the Against Malaria Foundation, and you like massively improve basically like a child's entire childhood with that amount of money, and you get this kind of nice little bug profile that shows how great a person you are. So like experiments like that are interesting, right? But like, basically, like it can't be like an NFT can't be something that you throw money at it and then everyone forgets about it. And I think if people can navigate this transition from just like NFTs being NFTs to NFTs being more meaningful in different ways, then like they could be part of something really interesting, right? And I think the thing about Ethereum that's interesting to me is how like it is this interconnected world, right? Like where you have these different people and they're building their different things in their own rooms, but you have the hallways that are connecting the rooms, right? You have applications that are talking to each other, and you have like one person that creates NFTs and then other people that create applications around those NFTs and then people create applications that talk to those applications. Like, I think this already happened once, right? Like, you had CryptoKitties, and then someone else created a game. I think it was like Crypto Dragons, and then the Crypto Dragons can eat the CryptoKitties or something like that. So, like, there's a lot of like this, I get, permissionless innovation, like the stuff that you can experiment with, and it's really fun. So, like, go and like have fun and go and make your NFTs and your fun virtual worlds interesting. Yes.
The proposers and the builders, who are going to get the new ETH minted? The proposers or the builders?
Okay, so who are going to get the new ETH minted? I see. Okay, so the economics basically are, if you're a proposer, then you get your proposal reward, right? So the proposal reward is like about 1/8 of the total reward. It's like 0.0 something ETH, I forget the amount. If you're a proposer, you also get the bid from the builder, right? So whatever the top bid that you find is, you also get that. If you're a builder, then you lose the top bid, right? The top bid is what you pay, and then you gain whatever transaction fees and whatever MEV are in your block. So proposer, they get the reward in the bid. The builder pays the bid, and they get transaction fees and MEV inside a block. And then attesters, they get 7/8 of the rest of the reward, which is also proof of stake issuance.
So, from what I understand, your proposal to separate proposers from builders is so that you can decentralize opportunity for MEV, right? So that random people can access MEV and okay, but random people don't have access to a lot of money,
right?
So they would go to liquidity pools, right?
Right.
So is there like any risk that that may lead to centralization? Liquidity pools being the ones that control, the proposals.
Right. Okay. Good question. So a couple of answers, right? So one of them is that, like, I think, like, one of the functions is, yes, to make it more accessible to be a builder, because you don't have to be a stake pool to be a builder. But the other function is to democratize being a proposer, right? By basically saying, like, you don't have to understand MEV yourself to get good revenue as a proposer. So even if building becomes very centralized, we've still accomplished a second objective, right? Because as a proposer, all you have to do is just like accept the bids. It becomes even simpler than before to be a proposer. Now, can we make it be less centralization favoring to be a builder? Yes, and there's a few answers. One of those answers is the way that the Flashbot's marketplace works, right, is that you can have kind of like multiple tiers of participants. You can have searchers, and then you have participants that take blocks from searchers, and they put blocks from searchers together. So then individual searchers, they can specialize in like individual things, right? So you might have one searcher that specializes only in, say, MakerDAO liquidations. You might have another searcher that specializes in arbitrages between Uniswap and SushiSwap on stablecoins. You might have another searcher that specializes in, arbitrages between SushiSwap and Binance on Kyber tokens, right? So, like, you can have individual searchers that specialize, and then you have kind of these other actors that combine them together, and so you have like more smaller actors in the ecosystem. Now, in terms of liquidity pools, the thing that you can have is you can have like these generic liquidity pools, right? Like you can have for not for all kinds of MEV, right? Like if you have MEV that's like between Ethereum and Binance, then this gets harder, right? But if you have MEV within Ethereum, then you have flash loans, right? Like you don't have to provide the liquidity yourself. You just have to just flash borrow it. So there are things that we can do, but like it's not always perfect, right? Like sometimes, if you are doing arbitrage between Ethereum and Binance, then like yes, you need liquidity on Ethereum and you need liquidity on Binance. And so like that part of MEV gathering might be more centralized. But like because there is the possibility of creating this kind of multi-level market where you have searchers that create individual bundles, and then you have these bundlers that combine the bundles into bigger bundles, you can create a system where like even if one type of MEV gathering becomes very centralized, the other types of MEV gathering can still be very accessible.
Yeah.
Okay, perfect.
Yeah. So, the question from the about the virtual machine. So part of the transition, I understand, is change the virtual machine from the current EVM to the WebAssembly based one, and of course that has a lot of advantages, but also due to the huge code base and everything, I mean there's also some challenges. Can you talk about it a little bit?
Yeah, so I mean, unfortunately, I think changing the VM is likely one of the lower priority things for us. There has been this proposal floating around, right, of moving away from the EVM in its current form and moving to WebAssembly or WASM. And the two main advantages of WASM that people talk about, one of them is that it's just more efficient because instead of having 256-bit numbers, you have 64-bit numbers. There's even just-in-time compilers for it. There's a lot of infrastructure for it. And the second is that WASM allows you to put in existing libraries because WASM is more standardized. So I think one of the things that we discovered that made us less enthusiastic about WASM is that we realized that a lot of the speed advantages don't actually exist. And there's two reasons why the speed advantages don't exist. One reason is that the compilers that are fast are actually not safe, right? Like the compilers that are fast, they actually have vulnerabilities. Like if they're fast or if they can compile average case programs and execute them very quickly, then on worst case programs, they perform very poorly, right? There's quadratic attacks, there's worse than quadratic attacks. And so like if you start using a just-in-time compiler as was the VM, then it actually becomes very vulnerable to attacks. And to prevent this, we basically have to use interpreters, and interpreters are actually not very fast, right? So that's one reason. The second reason is that it turns out that you can get most of the speed improvements by combining the existing EVM with special purpose features that make very specific things faster. So for example, there is the EVMX effort, which is also called EVM 384, which is basically trying to include fast big number arithmetic as a precompile into the EVM. There's ideas for precompiles around like very specific operations, like maybe binary field operations. And like the theory is that if we just have a couple more of these very low level precompiles, then we actually can be fast enough to do like, most cryptography within the EVM, and that's good enough, right? So, and the challenge with just kind of like this idea that WASM lets you import existing code is that like existing code is often not optimized for running inside a blockchain, right? Because for example, one thing that you need to optimize for running code inside a blockchain is that you need the code size to be very small. Most VMs that are not blockchain oriented, the code size is huge, right? Like if you just go and like make a hello world C program, the output size is going to be 4,400 bytes, right? Like if you make something even slightly bigger, well, you're pulling in like stdlib and then like it blows up even more, right? So like existing tooling ends up not being very useful because like it's just not designed around minimizing code size. It's often not designed around like the extreme safety requirements that blockchains have. So, in general, like basically, like the kind of reasoning for us is that okay, what WASM maybe if we do it well, like it can make some things twice as fast. But then we also have sharding that can make it. You have rollups. Rollups can make Ethereum 100 times more scalable. Sharding can make it 100 times more scalable. Proof of stake can make it 10 times safer. So there's just all of these like 10 and 100x improvements, and like realistically, we want to take the big improvements before we start looking at the smaller ones, right? So like that's the reasoning why I think WASM is not short term. Now WASM can happen in the longer term. There's two ways that it can happen. One way is if Ethereum finishes all of the high value stuff, then we could do WASM at the base layer. The second approach is that WASM can happen inside of rollups, right? A rollup can have any VM it wants to internally. Like Arbitrage is designed to be fairly VM agnostic. You can even make a ZK Snark prover for WASM, I think even more easily than you can make one for the EVM. So I think we're going to see WASM rollups, and I think people who want to use WASM or can use WASM in Ethereum by using WASM rollups, and I think that's like perfectly great as well.
Yeah, hi Vitalik. Longer question, so bear with me a little bit. It's related to the question of my colleague from Thomas earlier. So it goes like this: as long as there is more money in circulation than there is in the staking contract, a new contract with a larger amount can be filled at any time, and more validators can be activated based on that malicious contract, right?
No.
I didn't finish, so it's a little bit longer, yeah. So, and the malicious validators can delay the network and create confusion, feud enough to create an exploitable flash crash on the price of Ethereum and all the dependable assets.
So if your premise of the question
I'm trying to understand the attack, right? So the attack basically says that the attacker creates a completely new deposit contract.
Correct. With more money than there is in the circulation. Yeah,
I think like users are just not going to listen to that deposit contract, right? Because the deposit contract is hard coded.
Okay, but for example, right now, okay, ARK investment, let's say it's a big one. Okay, so recently they just said that they will deploy 60% to Bitcoin, 40% to Ethereum.
Okay.
So someone with that a lot of money and man and tech power can really exploit it.
Okay, fine. So if you have 20 million ETH and you put 20 million ETH into a deposit contract, right? No one recognizes that deposit contract. If that deposit contract has the same code, then you're basically burning 20 million ETH. So like there's just no. I feel like there's just no point.
But if you but if you short it and you create like the malicious contract, the profit made from the shorting of ETFs or the futures contract can be bigger, and they can acknowledge the loss.
I don't think that's actually true, right? Because, like, first of all, I don't think the attack works because no one's going to listen to the new deposit contract.
You missed a bit of information on the attack. So supposedly you can also set up some new validators.
Okay, on the existing
that use the malicious contract. You
No,
know,
but
new machines that
there's no I think like there's like any attack that uses a malicious deposit contract like cannot succeed because nobody listens to the malicious deposit contract.
Well, yeah, but again, you can set up new machines like maybe rent some Amazon Web servers and use those to refer to the malicious contract and then create confusion on the network.
Right, but like how would that happen, right? Because like from the point of view of anyone who is a user, right? If I'm a user, then I have like my client's code, and my client code only recognizes the deposit contract that has already been published, right? So my client, like whatever you do with your 20 million ETH, my client is not going to be able to tell the difference between like what that and Justin Sun moving money around, right? Like it's like from the point of view of consensus, it's just not going to care. So I think if you want to actually like manipulate the consensus, you basically have to just like deposit all of your ETH into the existing deposit contract and take over 50% of that. Which like you can do, right? And if you do that, then like you're gonna make Ethereum break once, but then like you're gonna get an activity leak, you're gonna get slashed, and so like you basically just like burn on like many millions of ETH to break Ethereum once, and like you might think you make a profit from shorting, but maybe like people are going to realize that like, hey, some crazy guy like burned 5% of the ETH supply to give us like 2 days of downtime, like amazing party, and the price of ETH shoots up and you lose even more money, right? So I do feel like there isn't actually a big opportunity here.
Can I add something?
Sure.
So also on the financial side, shorting is not an unlimited quantity that you can short. There has to be somebody to match the other side financially for general ETFs and any sort of shorting opportunities to exist. So you can't. There's nobody's going to match your 20 billion just as you're starting it. So you won't find a market because somebody needs to long on the other side and they make bad money on the fee difference.
This is only on Ethereum, but you have to assume that there are other assets built on top of Ethereum that might suffer because of this. Like 2 days of downtime is quite a lot for
That's true.
Okay.
It's not just about Ethereum, it's about the whole DeFi. If they shorted all of it.
Yeah, I mean, like that's definitely a good argument for why like Ethereum might not be very secure if, say, the market cap of all the DeFi tokens becomes like 100 or 1,000 times higher than the market cap of ETH. But like right now, ETH the asset is doing well, and so like I don't think that's very realistic right now. But I mean, if ETH crashes to $4 and DeFi and like, but there's still a lot of DeFi on ETH, then that is something to worry about.
I know you're involved in Stonercat project.
Okay.
What's your plan about this collection?
What's my plan? I don't know. I mean, it's like, it's a show, and they have cats, it's cool.
What's the utility?
What's the what?
The utility.
The feeling?
Utility.
Utility. Oh, I see. I mean, like they have they're selling NFTs, and those NFTs I think can be used to view the show, and they might do more things with them in the future. Right?
Hey man, how you doing? Ooh, that's loud. First off, friends don't let friends trade with leverage. My name is Carl from Code Cryptocurrency. Just wanted to say you changed my life, so thank you very much. Do you want a serious question or a fun question?
Both.
Cool, the fun question. In a parallel universe, if Blizzard didn't nerf your character, do you think you would have become, with the realization of the horror of centralization? Do you think you probably would have? Yeah. And the second question is, with all this explosion of NFTs in the last 6 months, do you think that has accelerated your plans to go to Ethereum 2.0 because of the high surge in gas fees and with the high demand on the space because of all the overpriced JPEGs?
I think the surge in gas fees has definitely accelerated a lot of the entire scaling roadmap, right? So I know it has made the roll-up teams work faster. I know it's like made people move faster in terms of getting the ecosystem onto rollups. So it definitely is something that has made a big impact. I think if it worked for NFTs are a significant part of it, but I don't think they're everything. Like I think if it worked for NFTs, DeFi would have done that on its own as well. So one of the applications would have done something, right? And there would have been, I think, either way, a lot of pressure for the layer 2s to start working and developing faster.
My question is sort of political, and I totally understand if you don't want to answer it, but you met with people from the Central European Bank, right? And I just wanted to ask if there's something that you can share from those discussions. This would be like the first part of the question, and second part would be, how do you see the the world economy working based on the fact that we are starting to see shortages, and is there an opportunity to centrally or having an AI centralized planning of the economy based on tokens for whatever resource we have? Do you see it happening? I mean, short term, long term, how do you see it unfolding?
I mean, I guess so. For the first question, I feel like from what I remember, those discussions, they were fairly generic, in that we wanted to understand more what was happening in the Ethereum ecosystem, and I wanted to understand more what they were thinking about. I don't feel like I have that any big insights, I guess, to take away from there. In terms of what the economy might do in the future with tokens, I guess the challenge with creating any kind of new token-based mechanism for allocating resources is he needs to have an argument for why it would work differently from existing markets, right? And sometimes there are answers, but often if the economics are the same, it'll just end up working in the same way. So that's the sort of thing where you do have to kind of really think hard about the economics much more. And the wrong kind of thing might end up just basically being a market as it exists today, but worse in some way. So I don't know. I guess my general kind of way of thinking about this stuff is that I think the thing that we really need right now is just more experiments. We want to more small countries trying different things, more cities trying different things, and there are blockchain-based things that do make sense. You could do blockchain-based kind of quadratic funding, maybe voting, maybe Harvard taxing things, maybe issuing local coins that have different properties. We see what works, we see what doesn't work, and then the successful things go from there.
Okay. Hello, I have a question regarding an article I read about El Salvador. I was wondering if you can say something about the situation over there and what's your opinion on their decision to adopt Bitcoin, and if you have any information about any other country maybe adopting Ethereum as a legal tender.
I guess I think countries wanting to adopt like cryptocurrencies, you know, whether it's Bitcoin or Ether, is great. I think El Salvador is definitely not the only one. Like I saw recently there was some article like in Panama they were considering a law that basically would make Bitcoin and Ether like legal for kind of use in certain types of government transactions, which is interesting. And then like aside from accepting currencies, there's lots of other things that governments can do in blockchains. So like those things are good. I think the things that you want to avoid, right? Like one is that like the El Salvador Bitcoin law in particular, right? Like there's this provision, Article 7, that basically says like it's mandatory to accept Bitcoin. Now you could argue that like, oh, well actually you can take the Bitcoin and you can convert it to fiat immediately, but it still like becomes mandatory to use the software. And then the rollout was very quick, right? It ended up like the wallets that most people use end up being fairly centralized, or like Chilo's fairly centralized internally. So there's like if you do this kind of rollout to a large group of people fairly quickly, then like there's a lot of risks and there's a lot of bad things that might end up happening. Like I saw there's already news of like people collecting the $30 reward on behalf of other people. So the kinds of adoption that I'm more of a fan of is kind of like starting smaller and like definitely like don't force it on an entire country, and definitely kind of don't force it on a country quickly. But you know, aside from that, right, like I think it's important to have kind of like nationwide and mainstream adoption of cryptocurrencies happen correctly, and you know happen kind of more carefully, so that people have more time to learn about it and adapt to it, and they adopt it if they want to adopt it, and if it fits their needs. But like if it can be done well, then I'm definitely supportive of countries wanting to be supportive of crypto and kind of actively help it succeed.
Thank you very much.
Vitalik, I want to ask you something from the founder view.
Okay.
It is any moment.
Okay.
Sorry, last question.
Yeah.
Is that fine?
Yeah.
Yeah.
Okay. Go. It is any moment in your life when you are afraid of competition, even if it's Bitcoin or Ethereum killers?
I mean, sometimes, though definitely less than before. I mean, I feel like the blockchains are moving in the direction in which they're not quite competition. Like they just kind of, they're different universes. That often work under very different principles, and you know, people who like one set of principles are not just often end up finding the others completely not interesting. Right, like you know, if you're a Bitcoin person, then you just think that Ethereum and all the others just make completely unacceptable trade-offs, and then like a lot of people who like proof of stake chains think that proof of work is just a completely unacceptable trade-off. So there are different kinds of systems that have different properties, and they kind of optimize for doing different things and satisfying different communities. And so I think that's fine.
Sorry, I misunderstood what was happening. Are you happy to take more questions?
Sure, one more. Okay. Yeah, ultimate question.
Hi, Alex, journalist. Nice to meet you. The question is, the regulatory frame is incoming and the crackdown is incoming. I heard you talk about it in multiple interviews. How do you think regulatory frame for crypto and for blockchain should be, and how should it come? Because the financial regulator in America invited the companies in crypto to come up with a solution to talk about possible frame. How do you think this should go worldwide?
And look, I don't claim to have all the answers. I think well, like what I can say is like ways in which like it should not happen, right? So like for example, like what happened in the U.S. with the infrastructure bill in the summer, right? Like I feel like there were a lot of mistakes there, right? Like if you just look at the contents of the bill, for example, right? Like it started saying that all of these different actors have to provide all of this information, but like they're just random nodes in the network. How are they going to get this information? And then there was an amendment to the bill, and it turns out that the amendments to the bill only exempted proof of work and not proof of stake, which like from the point of view of like I think the Ethereum community, where a lot of people are really proud about our move to proof of stake and like us being able to do this kind of really good thing for the environment. It's like, wait, WTF? Like, why is this law going against us now? So I think that ended up offending a lot of people. So like, it's better if things like that don't happen, and if like the regulation does get kind of built with kind of inputs from both the financial regulators and like from the crypto community, like definitely not just companies but also users in mind, right? Like I think the things that could go wrong, right? Like is that like one is that just the like really bad laws that get put in place that make a lot of things just illegal for no good reason. The second thing that could happen is laws get put in place that big corporations can easily get around, but then smaller corporations can't. So like, this happens a lot in markets all the time, right? Like, you create a law and then the existing players can comply, but then new players just have no ability, like just cannot get the like $20 million legal teams together, and they have a harder time. So like, it's definitely important to avoid all the traps. And it's also, I think, important for the crypto community to kind of understand at least like what are some of the concerns that that regulators have that the crypto community actually can address on its own. And like there are definitely going to be places, like inevitable places where there are points of disagreements, but like at least not have unnecessary ones, right? Like I think the regulators don't like scams. The crypto community also doesn't like scams. So like let's work harder and find better ways to get rid of the scams, right? Like there's things that the crypto community itself can do a better job of, and I think we should do that as well.
Thank you, Vitalik.